Hello, chart watchers, and welcome to this Monday, December 17th Market Watchers Live show with your hosts, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, I don't want to over-dramatize anything here, but the S&P 500 did move down below the 2581 price support level that was established on February, I believe it was February 7th, 2018. But so far, we are rallying back. Currently, we have the Dow Jones Industrial down 40, but well off its earlier low. The S&P down just under 2 points, but also off of its earlier low, which was down in the 2560s. The NASDAQ actually up 11 points after being down below these prior lows that you can see on the chart. Russell 2000, also nice reversal. So across the board, we are reversing, certainly not out of the woods, but from a bullish perspective, doing what needs to be done so far today. 10-year Treasury yield down nearly 2 basis points, 2.875%. Volatility index on the rise earlier near 24. It has backed off a little bit, but still up about 4.5% today. Financials leading to the upside. This was a group that had been underperforming badly the last couple of weeks throughout so far the first half of December. We are getting reversal so far today. That's encouraging. The materials group, which also had been under a lot of pressure here in December, trying to reverse, currently showing a positive move today. To the downside are a couple defensive areas which had been leading the market. You can see the real estate last week or so has been coming down, but the overall uptrend in play. And then utilities having a rough day today after having a very strong start to December. As far as individual companies go, when we look at the Dow Jones, Boeing, best performer in the Dow today, up about $7.50. Johnson & Johnson continuing the weakness that we saw last week. They had come out with a report, or there was a report out there that Johnson & Johnson was well aware of asbestos being included in baby powder, and the stock got really hit hard on Friday. Very, very heavy volume. That weakness is continuing this morning, putting a bit of a little bit of some weakness on the healthcare area, along with the healthcare providers, by the way. After the market closed on Friday, the Supreme Court ruled that Obamacare was unconstitutional, and so many of these healthcare providers are down. Many market pundits, though, are expecting that the Supreme Court decision could be appealed. And so we'll see where that goes. But for now, in the short term, a couple things really weighing on the healthcare sector. All right, Erin, I tell you what, today, and again, I said at the beginning, I don't want to over-dramatize things, but, you know, when you look back, and I wrote an article in Chart Watchers over the weekend about the difference, at least the way I view bear markets and corrections. And the one thing that stands out with corrections is you don't lose price support. And so far, looked like earlier this morning we might be losing that 2581 level. Now we're reversing back up. I'm going to throw my hands up in the air. I'm not sure which way this market's going today.
I think a lot of us have our hands up in the air. Obviously I'm still a bear. But yes, I knew when I was looking at our market action on Friday and of course what's happening today. And I thought, Tom's really going to be straddling right now the line because you're getting mixed signals that way. But yeah, I still am very bearish. So
I would say straddling is a great word because I actually was shorting netties from the end of last week, and this morning when it was down, I was looking at a lot of things, and I'll share that with everybody in a couple minutes. It's kind of funny. It's deja vu. But anyway, when I saw it, I saw the market reverse back to the upside a little bit. I said, okay, I'm going to get out of that short. I put on a couple longs. And honestly, I put stops in immediately under the earlier lows today. So I'm just trying. I don't know which way the market's going, to be honest. But I do think that the reward to risk favors longs, at least in the short term, unless the market breaks down this afternoon. Then I would completely be out on the long side, taking no chances. But anyhow, going to be a fun day for sure. I mean, we like the excitement. Certainly plenty to talk about right now. And
yes, absolutely.
We'll go into the schedule and the agenda, and we'll get this all started.
All right. Well, upcoming schedule. Tomorrow I'm going to be doing a workshop called Building Blocks of Technical Analysis. I invite you to bring any of the folks that you talk to about technical analysis. Tell them to come and watch this. I'm going to talk about very basic TA concepts, and hopefully it'll help people maybe get on board and start following this more closely. Danielle Shea will be with us on Wednesday from Simpler Trading. And Thursday, Julius, Mr. RRG, will be with us. And of course, Friday, What's Hot, What's Not will be occurring. Today's agenda, it's Monday. So Monday setups is going to start the day after our news and headlines. Earnings Spotlight, we have our special guest, John Hopkins, coming in for that. We have our first symbol for the 10 and 10. It will be Applied Materials, AMAT, AMAT. And then we'll finish off with the sentiment update. I'll give you what I'm seeing right now as far as polls and money flow. So stick around for that. All right, Tom, technical news and headlines.
All right, let's take a look at what's going on here so far today. You can see the economic reports that came out this morning. Not very good. December Empire State Manufacturing Survey, basically in half of what was expected, 10.9 versus 21.0. And then we had the December Housing Market Index come out way below expectations, 56 versus 61. Not very good. And when we take a look at what's going on in the Treasury market, it's somewhat understandable. We got folks running into Treasuries. You can see the yield pulling back. Unfortunately, that has not put a crimp yet today in the S&P 500, although I did say earlier that we had dropped back down below some key support levels, but we've rallied. I think we're teetering here. And I'm going to go over a couple things about that in just a minute. But just know that the reports today, economic reports, were not good. 10-year Treasury yield still struggling here. And as it moves lower, it simply tells us money is rotating into the more defensive Treasury market. Now, there were no earnings reports out this morning, at least no significant ones. But we do have some coming out later today. Probably the big one is Oracle. So let me go ahead and just pull up that chart for you. You can see Oracle right here currently in this overall downtrend. I don't like the fact that we lost support at about 46.5, went down below that, came back up. Look at the failure at the 20-day moving average, and now rolling back over here to the downside. So overall, I would say Oracle doesn't look very good heading into its earnings. So maybe we'll get a surprise. It is an influential company, big company. And so it would certainly help the bulls here at a major support level to come out with a good earnings report and forecast. I'm not holding my breath as we go into that report later today. We shall see. Looking at some of the other things in the market, maybe worthwhile checking out. I'm going to go ahead and pull up this newsletter article. I was kind of joking a little bit with Erin before the show. And when I went back and looked at the history of where we were sitting back in 2016 in January, this was a Chart Watchers article. And by the way, Chart Watchers came out over the weekend. Everybody should subscribe to this newsletter. It's an amazing newsletter, a lot of great commentary, tremendous amount of respect for everyone that posts their technical views in the newsletter. And I'll show you in a couple minutes where you can go to sign up if you're not already signed up and you're not getting that information. But this was back in January 2016. This is when the market was about where we are right now. We were teetering on price support. We had gone through a very lengthy sideways consolidation or correction. And I just wanted to point out, and I'm not poking at anybody, so please take this properly, but I think it illustrates how difficult the market is right now and what we're trying to figure out and how important these next couple of days or weeks could be. Back in 2016, I'm going to scroll down here to an article John Murphy wrote. And John Murphy was talking about how the advanced decline line had turned down on the New York Stock Exchange. You can see it breaking down at the beginning of 2016. I wrote about a lot of the same stuff. Things in January 2016, I started seeing breakdowns everywhere. About the only thing that hadn't broken down was the S&P 500. When I looked at Arthur's article, Arthur Hill, another great technician, he was looking at the fact that many of these companies most S&P 500 companies were well below their 200-day EMA. Only 22% were above their 200-day EMA. So obviously breadth was very, very poor. I went down and looked at, I think, Greg Schnell's article at the same time. And remember, it's it's easy to go back and look with hindsight and try to figure out, okay, what was everyone seeing? What were the issues? And one of the things Greg had pointed out is we were trading below the 40-week moving average. And when that starts to roll over, you can kind of see 2007, 2008 bear market did the same thing. And also 2001 started to roll over and you started trading below that 40-week moving average, which can signal bear market. So when he's looking at this back in January 2016, he's pointing out the same thing, that, hey, this is bear market type behavior. Erin and I were talking earlier. I know Erin, when she did hers, her article for that weekend, she was talking about how defensive areas were leading the market. I think somewhere in here, Erin, you had mentioned the XLU and the XLP were leading, and that's never a good thing. You did actually say, though, here at the bottom, I'll give you some credit. You talked about that they were showing weakness, which could be indicative of a possible market bounce. And we're seeing a little bit of that weakness right now today, as I mentioned earlier, with utilities and real estate. I was on the fence. I was literally about where I am right now, starting to see major breakdowns. The banks were breaking down. Well, banks are breaking down now. The transports were breaking down. Here was a weekly chart on the banks, and you could see a trend line moving up and a rising head and shoulder formation. We broke below. I mean, there were so many negative signs that were happening back then. And let's move over here and let's take a look at, well, first, this is just the current S&P. I'm kind of watching this to see if a short-term, if we can get a short-term breakout. This is overhead resistance line from this is a 10-minute chart, by the way. So this is only going back the last 2 or 3 days, but we've been trending lower. So one of the things I want to see is a big breakout above gap resistance. We gapped down earlier today. I'd like to see this thing really blast through 2,600. But let's take a look at the chart, and we're going to go back 3 years on the weekly chart on the S&P 500. Actually, I'm going to need to go back a little bit further. Let's go 5 years. And when I look back 5 years, here is the S&P 500. So here's your first move down in October 2014. We went back up to higher highs. Same thing we've done in 2018. We've come back down to test that prior low, almost test that prior low, which is what we did in October. We almost tested that prior low. And then we came down for a final low, which on an intraday basis, we actually went down below that prior low, which would be 25.31 currently. So here we are. 25.81 was the low close on a daily basis. Back then, I don't remember the daily close. I think we actually went below the daily close. And for one quick fleeting moment, we went down below the intraday low that was established in October 2014. But look what happened after. And again, we've got some really good technicians. I'm privileged to work with a host of really great technicians. And we all were seeing kind of that same thing. And I actually started writing, I think in February in my blog, that this is a bear market. And I want to show you why I thought this was a bear market. I took a look at, of course, the S&P, which looked like it was just a matter of time before we get that breakdown. Let's pull up the Russell 2000. What was the Russell 2000 doing then? Look, it had broken down below those prior lows. And what's it doing now? It's breaking down below those prior lows. Transports broke down a mile below those prior lows. What are we doing now? Breaking down below those prior lows. How about crude oil? Crude oil tumbling below those earlier lows, setting new lows in January, February. Signs of global economic weakness. What are we doing now? We've taken out those prior lows. Looks like crude oil is completely falling apart. I mean, my point is, and I could, do some more. Let's do the banks. So we go into the banks, and the banks broke down in January below all these prior lows. What's going on now? Well, we're way below those January, February, April lows and pointing down. My point here is that everything was breaking down back then. The only thing that held was price support on the S&P 500, and it ended up being just a nasty correction. So we're sitting here at the exact same point today, and this is what I'm very nervous about. And when I see the volatility index in the 20s, I haven't gotten this breakdown yet, but I see so many other things breaking down below earlier lows, it makes me turn bearish, more bearish. And some of you might say, well, if you're going to call bear market, you're late to the party. not so, I don't look at it that way. To me, correction and bear market are very similar until you start to see the lower lows and lower highs go in play that you get during a bear market that you don't get during a correction. Corrections and bear markets both start the exact same way and from the exact same point. High volatility, impulsive selling, and the difference is corrections hold support and go higher, bear markets don't. And so this is why I think this level is still critical. I believe this is going to be the start of a bear market, but I just wanted to point this out because I made bad calls back in early February of 2016. I'm not going to say anyone else made bad calls because they're just based on their technical indicators. And those technical indicators do tend to work, but they're not perfect. None of our technical indicators are perfect. So even if you believe this is a bear market, I know I'm rambling here, even if you believe this is a bear market, I still would be somewhat cautious. You don't want to get caught in a bottom of a correction right before a big move to the upside, thinking that the market can only go down. So that's the reason I pointed out. Erin, I'll let you take it over. Take whatever time you need for your upgrades, downgrades. I know I ran over a little bit, but I think these, looking at history and trying to learn from history is really important. So I wanted to point out some of these things.
No, absolutely. I think it's a great lesson in history to see where we were, where we are today. I like to go back sometimes too and just see, read my old blogs and see where I came in, as to my position, and then look at, well, what happened, was I on top of this or not? So, yep. All right, so let's go ahead. I'm going to get to our Monday setup, or not Monday setups. I'm getting to our upgrades and downgrades. So let's go ahead. We're going to start with Carnival Corporation. They were upgraded today by Cleveland Research from a neutral to a buy. Let's make this nice and big. All right. I have to say, for me, of course, I wouldn't be on the buy side of this, but I can see where they might have come in here because of the support level that you have back here in July and in the summertime, and that might be where you're going to see the move to the upside. I mean, the PMO is starting to decelerate, but overall, I'm really not, I'm not enamored with this particular stock. Lululemon was also upgraded today. Stifel upgraded it from a hold to a buy. This one doesn't look quite as bad as the other, but it was interesting because looking at the upgrades versus the downgrades, I always find it interesting because a lot of times I think of them as opposite. This one I think is looking fairly good. I would just be a little bit concerned. You can see this gap we had way back here in May, end of May, beginning of June. That needs to get closed. It didn't happen yet. I suspect we're going to see that gap closed and that area become the support level, past this one low that we had short term. The PMO is flat, so we could see it turn up from here, but it just isn't. It's still not a healthy enough chart. A couple of other big name upgrades. Actually, I'll tell you about those later. There's a huge list today, tons of upgrades. But the interesting ones, honestly, were the downgrades. And I'm going to start with Best Buy. And this one was downgraded today from a neutral to an underperform. Okay, well, generally when I see these types of charts and no prior support within the prior year, I go to a weekly chart so I can see what is actually going on. All right, and here we go. So we are sitting at very important support here, right at that $50 mark. So I can see, that's the area where we're going to either bounce or we're going to, continue to fall and go for this area right here at about $37. And I think that's probably where we're going to go based on looking at the PMO, which is accelerating lower on the weekly chart. You can see that negative crossover that we had. I mean, if you wanted to watch this as like a bottom feeding kind of opportunity, go ahead. But honestly, right now, I think I would be looking more towards shorts, more towards cash, more into the defensive areas, possibly the gold, silver, that kind of thing. I wouldn't really be running into anything on the long side just yet. All right, Callaway Golf was also downgraded today from a buy to a neutral. And I thought this one was really interesting in that, okay, it did get the downgrade. I agree with that. You can see the PMO looked like it was going to bottom here when we got this, what looks like a symmetrical triangle, but symmetrical triangles are continuation patterns. So the expectation should be a breakdown. And even though the PMO was decelerating, but now it is starting to turn back up. And I still wouldn't look at this as a buying opportunity because the PMO is still technically in a decline. But I just want to annotate it really quick here. I didn't get a chance to before the show, some of the important things I was looking at. So here's an important level of support, in my opinion. You have these tops that we had back here in March, matches up with these lows that we had back here in April, and we've broken down below that today. So I don't like that. You've got possible support, and it lies all the way back down here, that $13 level. So, I don't think Callaway looks too good. It makes sense that they did the downgrade, but maybe a shorting opportunity is available right there. And I think if you looked at the weekly chart, it gets even uglier. Yes. So we'll have to wait and see on that one. And finally, the last one, Tenet Healthcare, was downgraded by Robert Baird from an outperform to a neutral. And have to be right on board with this. You can see really important support here, broken in the shorter term and from the longer term. You've got those little tops there that we had back at $22. We've fallen down below that. We're getting ready to close that gap. It looks like we haven't quite closed it. Yeah, we did close it today on the drop to that $20 level, but you've got a PMO sell signal below the zero line, like well below the zero line. So not liking Callaway, Tenet Healthcare. This one has definitely some big problems going on there. All right, so that concludes the upgrades and downgrades, and here they are. Other notable upgrades: Barnes & Noble, First Solar, G3 Apparel, Scott's in that home improvement sort of area. We had Scott's Company, Sherwin-Williams, and Stanley Black & Decker. All three of those were upgraded. And our other big name downgrade was Scanacorp, SCG. All right, Monday setups. How did we do? I guess we better go look.
Yep. Well, we both shorted last week.
Yes.
And I think yours did better based on our entry prices.
Yes. Let me go to the right. Yeah, no, this is where I want to be. Okay. Yeah. So MAS, Masco, here it is. I'm going to go to that chart because I think it's annotated somewhat. Yeah. All right. So yeah, I had the short, bought at $29.72. Stop was at $31.75, which we never really got close to. The target is still $27. I still think we'll see it. We dropped down below this area of even short-term support at 30. So PMO sell signal below the zero line came through. So I think I did okay. It's $29.50. So
that's a pretty good one. I do want to just clarify that you sold at $29.72, not bought.
Oh, right.
I want to make sure everybody understands.
Yes, thank you for that.
Probably don't understand shorting, but you're actually selling first, and then you're selling borrowed shares. Your broker takes care of all that in the background, but essentially you're just doing everything backwards. You sell first, you buy second, so you make money if the stock goes down.
Exactly. Thank you for that. I should have had that on there. So that was mine. I mean, I think we did okay.
Yep.
And yours was, let's see.
NetEase, NTS.
NetEase.
Yeah, I think it was 239 and change. And what I had mentioned was the possibility that it would go up maybe to fill that gap from August, the big drop down. And if you notice, we actually did go up above that on Thursday. We came back down. And then the very next day, that was actually a island reversal. So we had that last candle up there on an island. We gapped down. I believe if the market breaks down, NetEase is going to drop. I would be surprised if that rising 20-day moving average holds. I will say, just for disclosure, I did cover earlier today just because some of the things I went over earlier in the show. I'm still not convinced after looking back at 2016, everything I saw there. I want to see that breakdown. I've said before on the show, I don't short until I get that price breakdown. So I kind of stepped in there a little, maybe premature. Anyway, it was down a little bit. I took my money off the table, or the short off the table, but I still like this one to the downside, especially if the market breaks down. I think NetEase will go back down to those lows we saw in September, October, down below 200.
Sure. The PMO is starting to cooperate too. So you can see that deceleration, and it looks like it is starting to, it's going to top and head down.
Yep. So, all right, we got about 10 minutes. So why don't you take about 5 and see what you got for this week, and I'll do the same.
All right. So everybody, these are going to all be shorts. I didn't have a chance to put them in my list, so we're just going to go through them as we see. So again, all of these, I'm pretty sure you can't find support on the daily chart for the last year. I think almost all of them are set up that way. So I'm going to move over to MDCO, Medicines Company. I'm going to move to the weekly. There we go. Actually, we even need to move to the monthly because we're now starting to look at areas we haven't seen since 2012. All right, so let's move to a monthly and get even more, see what we need here. So I'm seeing this $15 level as a possible support level. I'm not really convinced it's going to hold, but look at this $20 level. Look at how important that support was right here. And we have dropped down below that today. We are trading below it right now. The PMO looks very ugly. So I like this one. On the drop, I would be looking for, I think my target to buy back would be at $15 for MDCO. I haven't decided which one I'm going with. I think I have the idea, but I'm going to just double check it as we go through here. All right, IDXX, and I'm going to take this one back to a daily chart and see where we are. Yes. So this one you can see also dropped below some important support. I want to show you very quickly. I know we only have just a bit, but I really want to show you how this, I want to show you this pattern. So you've got the declining tops and you have the straight line bottom for the base. This is like almost textbook declining, oh my gosh, descending triangle. You've got the breakdown that you should expect, and then the measurement is from back here, and so that is what we would expect as a downside target, which is you know, what is this, 190 to 215. So we're looking at about 25 from here, and that would bring you right back down here to these 2017 lows. So that's what I'm looking at on IDXX. It is a little bit lower volume, so you do need to pay attention to that. But I did like IDXX and for shorts. MPC was the other one I was looking at as a short. Again, break down below some important support short term. The PMO, we've got a second top now below, well below the zero line. Well below the zero line. So I don't like this one. And of course, no visible support right now, unless you go to a weekly chart. And there you go. Here's your very strong support level, $55. Totally looking for that. That would be the spot. You could expect it to go down, in my opinion. And that would be the area you watch or you cover. So, you know, you buy it back. That's what I would be looking at for MPC. So I liked that one as a short. Next Gen was another one. Here we go on the weekly chart. And again, looks pretty ugly. $14 seems perfectly, you know, that seems like an easy level as far as support when you're looking at the chart. But let's go look at a daily chart real quick. There we go. So you can see it's a short-term double top, and today is executing it. And the size of the pattern is 1650 to like 1850. So we're talking about a $2 difference. So you go to 1650, take $2 from it, takes you to 1450. Interesting, right? It kind of matches right up here with that $15 level, just a little bit below, telling you you're going to expect a breakdown on that. Remax was another one. And, you know, some of these were in interesting sectors, I had to say, but we've got a PMO sell signal. It looks like it's just about ready to happen. We've broke down below some really important short-term support from November and December. You go and look over here and you can see it's just, you know, more downside. It just looks like we're going to be heading down toward where it did when it initially joined the stock market. So it's not looking good. I would expect even more downside, even in the short term for that one. And SSTK, Shutterstock. Yeah, let me get this one on the daily chart here. All right. So in a very short-term look, you've got this trading channel, and we've now broken below that. You can see we're trading near the bottom of the intraday trading range, top below the signal line here. And where is the next area of support? Since you can't see it on the daily chart, we come back to that weekly chart, and you can see the area you should be looking for. Here's $35, and you can see that is where we're breaking down. I would be looking down here at that $27, $20, $30 level. Could even move down to that $25 level. Reverse flag that is executed, and the length of that pattern is almost 20. And so you take that away, it does. It brings us easily down here to test those lows back from 2015 and 16. So those were the ones I had. Now I have to determine which one, and I feel like it was going to be IDXX. Yeah, I think it was going to be this one, but I need to see a daily chart. Yeah, IDXX is going to be it, because we did break down below, and it is that textbook declining, descending triangle. So I like that. I could do my measurement, and so that's what I'm going for. Let's see, right now it is at 187.21.
All right, there you go. Let's take a look. I'm going to come right out with my pick. I'm going to go on the long side this week. I kind of was hesitating, going back and forth, but I'm going to go with Dexcom, DXCM. DXCM, you can see gapped up back here in August with earnings, really established a good area of support between 115 and 120. That was after the gap up on heavy volume. We never went back down really below that 115 level, just barely there. Notice the reversal here, bearish engulfing candle off of a downtrend right in this zone. Nice bounce. Came back down into just below 120 here, printed a hollow candle off of a downtrend. Actually, kind of hammer and then a hollow candle. Went higher. Came back down off another downtrend, hit this exact same zone again. Hollow candle bounced. Now it's back down here. What I'm hoping we get is a hammer. We'll see whether or not we do. I think from a long perspective, if you're going to go long anything today, you have to realize if the S&P 500 breaks down, I would be keeping intraday stops in below my support level. So DXCM, which I actually did buy myself, I have a stop in literally 1 penny below this 113.40 level. It's at 113.39. If I get stopped out, I'm going to lose about 2.5% or so. If it rallies and I can get back up, say maybe even to that 20-day moving average, I would take the money and run. So DXCM is going to be my pick, and the price right now, 116.54. Some other stocks that I thought were interesting, CRNT, and I think a couple of these we'll be talking about with John as well, because John and I talked about a couple of these stocks earlier today. CRNT, now it's getting hit pretty hard. The stock was 430 and change a week ago. Now it's down to 355. I actually think this gap support area, this is where all the volume came in. First time going back to this level. We could get a reversal from this level. So CRNT is one that I would keep certainly on my radar. An aggressive trader certainly could take a shot with it. Trade Desk, another one. This one had gone back down recently to about the 127 area. You can see earlier today got down to 126 and change, hitting that 50-day moving average. If that breaks down, I would be out. This is a stock, though, that has held up really well. It's been one of the best performers in the software space. So if the market holds and we bounce, I would look for TTD to rally with it. Dunkin' Donuts, this one was breaking down on big volume. I would look, though, and see if we get a huge reversal later today. This could be an opportunity to build some inventory for market makers. You can see the recent lows have been holding around 69 and a half. Today, we went all the way down to 66.60. If we were to reverse back on heavy volume, this is one I think in the short term could do well. I would not be a buyer, though, until I see that reversal. ONDK getting very oversold. Another one that I would look for a reversal. This is a key area of support. Right now, would I do anything? No way. A reversal later today that gets back up somewhere in the 650, 660 area with a long tail to the downside, I think would suggest a short-term bottom. FireEye. FireEye, I think, also coming down, testing some key support. right about here. This is where some volume came in on the move back to the upside after this reversal, that reversing hollow candle. If we can get back up close to that 50-day moving average, I think FireEye is one to keep an eye on. From a short perspective, GMS. GMS is coming up testing the 20-day. You might look at it and say, well, volume's been pretty good on the way up. Well, to me, it's a bounce. This stock was trading over 20 a little over a week ago, went all the way down below 15, and look at the volume on the selling. I think it is continuing the earlier downtrend, holding support so far, but I think this bounce to the 20-day is going to fail. I think this one goes back down. Chico's CHS, very, very weak group. Huge gap down with earnings, massive volume. It's worked its way back up. I don't think it's going to get back above that 20-day moving average. So as it gets closer, I like shorting on CHS there. And then finally, the last one is CF Industries. Downtrend, volume trends really weak. Trying to bounce. We were oversold, so we're getting the RSI back up into the 40s. But again, I think the first test of this 20-day is going to be a problem here. So let's go ahead and summarize our picks for this week, our setups. So Erin is going with IDXX on the short side. I am going with DXCM on the long side. And I tell you, I don't know. I think the winner could be based somewhat on what the overall market does. We'll see.
Absolutely. I think that will certainly have some effect. Oh, what's the price there? We didn't get it on the slide. I'm going to write it down.
Well, I can go back and check. Let's see here. DXCM. I'll just go with whatever it is now. I don't know if it's going to be better or worse. 116.16.
116.16. Got it.
Yep. So that will be the prices that we are into those trades. And I tell you, today's close. I can't really overstate it. I think this is going to be a big day in the market to see whether we hold on to support, but we'll see.
Yeah.
Okay, let's move on. We've got earnings spotlight coming up, and of course that is with John Hopkins. This earnings spotlight brought to you by earningsbeats.com. Earningsbeats.com provides high reward to low risk trading candidates, and they'll teach you to focus on the combination of strong fundamentals and strong technicals. Learn to exercise the patience and discipline of an experienced trading service. Earningsbeats.com, better timing, better trades. Mr. Hopkins, I got to tell you one thing, though. When I was just going through and reading a little bit there about Earnings Beats, talking about strong fundamentals and strong technicals, I know I saw in your Chart Watchers article over the weekend that you now have put together a week earnings chart list. So sounds like you're preparing for a possible bear market.
Well, can you hear me okay, Tom?
Yeah, you're good.
Okay. Yeah. Yes, as a matter of fact, we, as a general rule, we don't get involved on the short side in stocks, particularly when you're in a bull market. It's just really difficult, Tom, to make good scores if you're trying to short. Seeing signs now where it might not be a bad idea, to have some stocks ready for shorting. And so on our candidate tracker, also known as our chart list, we have gone ahead and added some stocks that missed earnings. So even though our name is Earnings Beats, we've got some earnings misses that are ready to go. And I think they just have to be prudent. You know what this market reminds me of, by the way? I was thinking about, in a football game, when you get down, to the wire and times run out, and the coach has to make a decision to go for one for the tie or two for the win. Mm-hmm. And in taking a look at the NASDAQ, it literally got within like 1 or 2 points of that April low today.
All right, let me pull it up.
Yeah, take a look at that.
All right, we're going to have to stretch it out.
You got to stretch it out.
Yeah.
When you got to start stretching charts out.
Yeah, right in here. And
right
also
there.
Low back in February, too. I mean, that area was right around that 6,800.
It's right there, so it got down to that level, and to me, this is where maybe you go for 2 points. And if it doesn't work, you just, if it works, you're a hero. And if it doesn't, in a game you go for 2 and you lose and everybody hates you. But this is one of those cases where the market's been so beaten down. But the key, Tom, like everything else, you got to keep tight stops, right?
Yeah, I mean, I definitely think you need to keep tight stops. I'd also, depending on how much time's left in the game and how many timeouts you have, that would decide whether or not I go for two.
It's true. Yeah, but anyways, so yes, if people read my article over the weekend, you'll see that I'm most definitely starting to get concerned about the market. And like you said, I think this is a pivotal day and week for the market.
Mm-hmm.
And a couple things worth mentioning. Number one, the Fed's got their announcement on Wednesday, and the market loves to throw a tantrum before the Fed meets.
Mm-hmm.
That's just the way it is. They throw a tantrum, hoping that the Fed sees what's going on, and they're a little more dovish. The other thing, Tom, we don't talk about this so much anymore, and it's kind of hard, for it to stand up sometimes when you have a bear going on like we do right now.
Mm-hmm.
But I took a look at some of the options on the index, like the spiders, the Qs, etc. There are a mound of puts expiring on Friday. And so it's just not going to surprise me. And plus, we're in a very strong time of the year. So I think today really is going to be a game teller. Are we going to hold here? If not, the market's going to continue to go lower. But the great thing about getting involved in stocks is if you have tight stops, it's not going to kill you. And I want to go over a couple stocks with you.
Yeah, one thing I'll add though about those puts, and just so everyone knows, I agree with you. I think it's helpful as you go into option expiration week to get a sense for what would benefit market makers. And clearly, if you got a lot of folks that have bought puts, then having the market close above those levels will save the market makers. But let me just say this: if the market keeps going down and the volume picks up and is heavy to the downside, you got to imagine that you've got a lot of shorting going on with the markets. That's why you get this impulsive selling. There's no buyers. Market makers aren't going to buy either. To me, it's just like the old matador with the red little cape, just letting the market go. I mean, that's
I agree.
The analogy that I use. And if the market makers are shorting, they're making money on that, which offsets the money they're losing on the puts. So just because they're out there doesn't guarantee you we're going to get a bounce. But I agree with you that if we get a false breakdown and a move back to the upside, it wouldn't surprise me knowing what we know about options and market makers for a quick rally. But I just wanted to throw that caveat out there that if we break down and the volume starts picking up, I wouldn't necessarily be putting all of my eggs based on what's going on in the options market.
Let's pull up the Nomad Foods, which is NOMD.
Yep.
Now, this is a stock, that if you take a look, you can see that, they made a really big move up, a nice volume beginning November after earnings. And then the stock just continued to pull back, and it pulled back to the 200-day last week. So to me, that looked like a pretty good place to get involved. We got involved in the trade at 1855, but we had a stop of any move below 1840. And, it hit our stop, 1830. We lost maybe, 0.86. And since then, Tom, the stock has gone down another 8%.
Yeah, well, this is the poster child for why you got to keep your stops in play. I don't have the 200-day on my chart. I don't use the 200-day much, but I definitely can see clear price support coming across here at about 1840. And all of these prior lows, especially after gapping up and putting in a new high, there is just no excuse for a stock to go back down below that prior low. To me, that is a signal
exactly.
It could be rolling over. So I agree. I agree with the stop that you set for sure.
You see, so that's what you do. When you get involved in a stock, just in case it goes against you, you have to be prepared. Let's take a look at TDD. You were talking about Trade Desk. This really, honestly, compared to the market's been kind of a monster. And we got involved in this stock today, just a little bit higher, than it is right now. But you see the low of the day is 126.08. We set our stop for any intraday move. That's the other thing too, Tom. You can have intraday stops or closing stops. When the market's just volatile, you have to have a backup of some type. So we've got to stop below the low of the day. If it goes against us, we'll lose a couple of percent. But think about it. What we're doing is getting involved in the market. The NASDAQ has tested, that April low.
Yep.
The market's probably getting a bit oversold. You get into a bullish time of the year. So you take a bit of a risk. If it works in our favor, this could be a 10 to 12% gainer if the market holds and turns, because I think TDT will go with it. On the other hand, if it goes against us, we're going to lose a couple % I don't mind that. I don't mind having a 4 or 5 to 1 reward to risk trade.
Yeah, I mean, I think that's the key and is so critical to trading success. And I've written about that quite a bit. I think you've got to manage your risk to the downside. I think if you're getting into a trade, a lot of times traders that make mistakes in the market many times are getting in for whatever reason, but they don't already have a pre-established notion of when they would get out. And so some of the questions I always hear as far as what is the toughest thing about trading is when to sell. Well, you shouldn't be thinking about when to sell after you buy. You should be thinking about where that sell point is before you ever buy, because otherwise, how do you establish your reward to risk on a trade? If you don't know where you're going to sell when you get in and you haven't really thought about your target to the upside, that trade might not make any sense. I mean, if you're getting into a trade and you think, well, if it goes up 6%, I'll get it, I'll take my money. But to the downside, I haven't really considered it. I'm going to start thinking about it after it's down 15%. Those types of trades are not going to work. So I agree. I think in the market we're in right now, and I've said this many times, I don't like to trade a market with the volatility index in the 20s because you don't know what you're going to get next. The market looked like it was reversing earlier. Last time I looked, the S&P was back down 20 points off its earlier high. And who knows where it's going to be by 4 o'clock today. We could be down 80 points on the S&P 500, and it would shock me. So you got to keep – I think the other thing is with a high VIX market, you have to have intraday stops. If you wait till the close and we get into one of these afternoons where we're just literally taking the Dow down 100 points at a time, that can get really painful using closing stops. I don't worry about intraday moves to the downside when the VIX is at 9 or 10. That's just normally that's a rarity that the market would ever take a huge plunge when the market's not expecting any volatile action going forward. But in this environment, anything is possible. So
agreed. All right. So last one, I just want to point out a CRNT. You were talking about that earlier.
Yep.
Look at the gap up and the volume for like 3 or 4, 5, 6 days in a row.
Yep.
That took that thing up almost to 5. And ever since then, it's come down, down. So you can see, we got involved right around this level that we're at right now. But we got to stop of any intraday move below 345. You just might continue to take this thing lower. But again, if you're going to get involved in a stock, you might as well do it, when it's pulled back on a lot less volume than those big bars there. Because I think if the market does turn, it's going along for the ride up.
Yeah, I mean, it's finally coming back down. I know the market has been struggling since beginning of October back here. And you can see that stock went up. And like you pointed out, very, very heavy volume. And that was earnings related. It came all the way back down, and I've just drawn 3 levels looking at this. This was a prior high, which we ended up breaking out above. This is the first time coming down testing that level. We've got the top of gap support now, 3.6, I don't know, 7, something like that, and then the bottom is going to be down around 3.45. I think somewhere in this area, I wouldn't be surprised to see a turn, especially if the overall market bounces as well. A reversing candle here would be very bullish indeed. And I do think this is an area where you could get involved. I mean, volume's picking up. If it loses that 345 level, I'd be real careful. But CRNT looks pretty good. And if it does reverse here, a move back up, even just to the 20-day moving average, which is a 408, would be a pretty nice.
That's a 10%. That's a really nice move.
Yeah, more than 10.
More than that.
Yeah.
Hey, listen, I know we got to wrap up soon. I want to mention one thing. We got a big event coming up.
Yep.
Wednesday. You're going to join me, which I really appreciate. It's going to be a good one. If you go to our website, actually, there's a 2019 market forecast link at the top. And it's no cost, by the way. We want people to be getting themselves ready for the end of the year, 2019. What's it going to look like? We'll be spending a good amount of time on our strong earnings and weak earnings chart list. Talking about some, potential candidates that could really be setting up. One thing about the market getting pounded, Tom, really, if anything happens and you do find a bottom, some of these stocks have been obliterated. And, so I think we're going to have a really good crowd. You can sign up for free, and hopefully we'll get a bunch of people to join us.
Yeah, you said a couple things there. I mean, number one, yes, some stocks have been obliterated, but this turns into a bear market. We haven't seen bottoms. I mean, and in fact, even some of the levels that you look at, like on stocks like Amazon and Apple, and you think, wow, I can't believe how much it's fallen. This is probably not even close to half of what they could drop in a true bear market. And bear markets typically go anywhere from a year to two, 1 to 2 years.
Yes.
So, I mean, we could be looking at a lot of different things going on in 2019, and I'm going to talk about some of that. And honestly, I'm glad we're not talking until Wednesday at 4:30, because that gives us a couple of days to look at the market. Because if we were doing it today at 4:30 based on what the market's doing, it's going to be difficult to do a forecast. Now, what I'm going to probably preface a lot of my discussion in 2019 on is whether or not the S&P 500 ultimately breaks down. And we might have that answer today or tomorrow, and we might not. And so we might have to continue to watch for it. But I do think that 2019 is going to set up completely different based on whether or not the S&P 500 can hold this key support level. If it doesn't, I think that completely changes the game. I think we'll see another big swoosh to the downside, a rally back up. And on that rally, that's the one you want to begin shorting, in my view. So a lot to talk about. I do want to mention it is a free event for anybody who's wondering. You have to register, so you got to give a name and email. And I want to say that the seating is going to be limited. So if you do sign up and you want to be in there for the live presentation, you better come in pretty soon after 4 o'clock. That's when the room will open. If you don't get in before we reach capacity, John, I think you had said you have a recording. Is that right?
Yeah, it'll be recorded. So we'll make sure anybody who doesn't get in, because I expect a full house plus. Standing room only, virtual standing room only.
Yeah.
But we'll have recording available for anybody who's unable to get in the room.
Yeah, and the other thing I'll point out before I let you go here is, I'm helping Earnings Beats out, trying to go through my background. I'm a CPA, so I like getting into analyzing things. So I'm currently going through and updating performance. And what I'll say in 2018, I mean, it's been a crazy market, very volatile. We hadn't seen anything like that since probably back in 2015, 2016. 2017 was just straight up. There was really very few pullbacks, very little volatility, easy market to trade. 2018 has been completely different. And I will say that I think in the first quarter of 2018 Earnings Beats, when I was looking through the numbers, you had 8 winners, 20 losers, or maybe 8, 19. Same thing for the second quarter, and in the third quarter, 7 winners, 15 losers. And you think about that and you say, wow, you're losing more than you're winning. But the average gains on the wins were in the 7% range, whereas the average losses were about 2%. And what that resulted in was actually making money in each of the 3 quarters and wildly outperforming the S&P 500 in the first 2 quarters. So I just want to say this: managing risk is the key to trading success. And it doesn't matter to me whether you're a day trader, short-term swing trader, or maybe even a long-term position type trader. You still have to manage your risk, and you have to make sure that your reward risk is set up properly. We're going to be talking about a lot of those things. So again, just a quick reminder, Wednesday, 4:30 Eastern, John and I will be hosting this 2019 market forecast as we go forward. Always popular, lots to cover. And again, it's free. Just go in and put in your name and email. And again, you get that at earningsbeats.com. and click on at the top 2019 market forecast and join us Wednesday.
And just remember too, decide if you're going for 2 points here or not, Tom.
Exactly. I don't know. I feel like sometimes I go for 2 points and I lose 6.
All right. Great. Thanks so much.
Thanks.
All right. Bye.
Bye. All right. So there is the earnings spotlight stocks that we talked about. Not very many. It's more about just trading strategy and the emotions and so forth behind trading. I don't like bear markets. And those of you who've listened to Market Watchers Live or have followed me for years knows that I'm not a perma bull. I've been called a perma bull. I'm not a perma bull, but the market goes up a lot more than it goes down. So I'm going to give the bulls the benefit of the doubt until the bears beat me over the head, which they're trying to do right now. Anyhow, Erin, we are moving on to the 10 in 10. What do you have for RRG today?
You know what? I'm not going to do the RRG.
Oh, okay. Never mind.
Right now I only have 17 requests. I'm expecting some more to come in the chat room. So I am not going to do the RRG.
Okay.
But we will be starting with applied materials.
Then that's where I'm going to go. Let me pull that chart up for everyone. Hopefully you got it on your screen now. Haven't annotated it yet, so well, I'll do that now. But clearly it's in a downtrend. Semiconductors have been very weak in 2018. That goes without saying, and applied materials has been a pretty poor performer. I can show you the relative chart if you need a little bit more evidence. Here is the semiconductors going down. Here's applied materials going down. And you can see relative to the group, applied materials has been very weak. Obviously, if you're trying to outperform the S&P 500, it's been difficult to do that with applied materials. And if you're trying to outperform with semiconductors, it's been tough. Trying to turn higher, but we've done this. We've seen this before. So I wouldn't get overly excited about that just yet. Let's, again, continue to watch the S&P 500, see if we break down. But as far as applied materials goes, I would be looking at the low that was established at the end of October. Here we've got a clear reaction high put in place. I think we're in a trading range off of a downtrend. Bear market, I think clearly applied materials goes lower and breaks below this 31 area. If we hold support, then I think this could be a very constructive base that a breakout above 38.5 or so would signal a change in character on the chart. So I think we just watch applied materials for right now. I don't see anything to trade here. I see a lot of mixed signals. And so I would just wait and see how this, which way this confirms.
All right. Excellent. It does look like our most popular in the chat room, everybody's interested in gold. So there were two different ones. So I think we've looked at Rand Gold pretty recently. Let's do Barrick Gold, ABX.
Yeah, Erin and I had a conversation before the show. I was going to shock everyone for the Monday setups because if the market had been breaking down at 12 o'clock and we were in, bearish territory, I was actually going to go with the GLD today for my setup because I think the dollar made a false breakout on Friday, negative divergence in play, and we reversed off of that today. We left kind of that candle on Friday. Well, let me just go ahead and pull that up and we'll come right back to this chart. But we left that candle on Friday up here on an island. So you got a nice move to the upside, but we broke out higher highs, lower PPO, and now we're back down, leaving that on an island. I could see the dollar going down this week. And if the market weakens, the last time when the market sold off, October and November, safety money went into the dollar. But if the dollar is giving signs of topping, I think that could set up really nicely for gold if the dollar were to pull back. So, anyway, but that's not what we had. That's not what I went with. So I didn't get to shock everyone. But having said all of that, if the market's weak, I do like the way ABX sets up. It is beginning to show strength relative to its peers. I think, here's relative to its peers. Here's its peers itself starting to strengthen. You can see ABX has been a really good performer. It's outperforming the S&P since the S&P started dropping back in October. So this has been, good space. And I think the pullback here to test the rising 20 and also to test price support around 1350 is very constructive from a bullish perspective. So let me pull that line up here. So this is about where you can see all of these tops coming across. Look at that false breakout right there. That's usually a pretty good short-term sell signal, which it was. And now we make the breakout, not a false breakout. We make the breakout, and now we're pulling back and holding support. So I can make a really strong argument on the long side on ABX. I think if you break and close below the 20-day, maybe you reevaluate. But for now, I like ABX.
Okay. Let's see. It was really funny, and they requested fat and lazy.
Those are the two stocks?
Those were the two stocks. So why don't we start with fat?
Oh, my gosh. All right. That's pretty funny. Fat Brands, FAT. It is in the restaurant area. So the restaurants have been doing well. Fat has not, though. It's actually, breaking down. On Thursday of last week was at a low for 2018. And it all comes while restaurants have been surging to the upside. So what does that mean? You got a terrible performer within the restaurant group. I would not be in this one. There's a lot of restaurants out there I think look pretty interesting, and have been performing really well. But I do not believe this is one of them. And I think maybe the thing to watch for, you got a little bit of a breakout there above the 20, but there you got a failure of the 20. Here was a failure of the 20. Several times we got close to the 20 without getting through. And then look at what we're doing today. after gapping up to the 20-day. Very, very bearish candle. I don't like it. I think it's a poor performer in a strong area, by the way. I mean, the stock should be doing well, and it's not. And so that, for me, means just ignore it. I'd sit on my hands.
All righty. Let's see. Let's look at.
Are we going to do lazy or no?
Yeah, I guess we could. Why not? We didn't have that many requests today, so.
All right. I thought you were giving both of them to me because I thought you wanted me to do both of them.
Yes.
All right. Lazy days holdings. Wow. Okay. I don't know if there was a positive divergence in here, but it looks to me like we're getting a reversing candle at gap resistance and at the 50-day. Big caution here. Look at the volume. I mean, I wouldn't trade this thing just because of lack of volume. Today, it's traded 3,600 shares. There's no way I would ever trade a stock with that kind of liquidity. It's probably only got one market maker on it, or maybe a couple, because it doesn't make sense. Most market makers can't make money trading, just 100 shares a day on a stock. That just doesn't work out. So I would say, based on the technicals, I would sell, and based on the lack of volume, I would just ignore it altogether.
All right. How about for our friends in Canada, Canadian Tire Corp, CTC/A.TO.
Wow. All right. Yeah, big gap up, just complete failure after that. I don't like to see these charts, that break down like this. Same thing really happened back in August. You can see that really nice candle, and then the gap down, probably earnings related, huge move to the downside. We gapped up, but nowhere near the prior high. Now we've moved to new lows. So you got lower highs, lower lows. I'm not liking it here. I don't have any of the, let me put it on a different chart here. No sense in having it on the relative chart. But yeah, I mean, today's candle, maybe it's bottoming short term. So I would be watching the breakdown level that we saw back here. There was support in October. You can see, look at the gap up failure right there. And then we've got the overhead 20-day moving average just above price resistance. So I'm going to say 145.5 up to about 146.5. Key resistance on any kind of a bounce. I don't like it. I don't like a stock breaking down at this point.
Okay. Let's see. Next one I'm going to give you is from the healthcare sector, a pharmaceutical, Tesaro, TSRO.
All right, TSRO. I'm guessing they got bought out or something. That's kind of a strange. Looks like the stock gapped up. I don't know if it really makes sense to even technically try to evaluate this. It looks like maybe it was a cash buyout or something that took place beginning of the month. So you want to just add another stock?
Oh, yeah, no problem. Let's go ahead and do NRG.
All right, this is definitely in the energy space. Big breakout. I think this stock looks really good. Pullback, I would prefer. I like to buy pullbacks in strong stocks, and clearly it's a strong stock. There's your breakout. You got your rising 20-day moving average, which has just crept up above your support level. And so anything back down close to 40.5, to me, looks like a much better reward to risk entry. So I like the stock. Just want to simply wait and see if I can get a little bit cheaper.
Okay. Let's see. How about we go to Fate, F-A-T-E, Fate Therapeutics, a biotech.
All right. Well, false breakout. That resistance level was up near 17. So short term, that usually creates problems. It's come back to the 20-day, but I think it's a buy here. Once again, the overall market scares me. And when that's the case, if I like a stock and I want to be long, I probably would buy half of what I normally would buy. But I think the 20-day, I could keep a fairly tight stop. I could maybe even go down intraday below 15. It got as low earlier, 15.35. Currently, the reward to risk isn't as good at the current price, 15.81. But the key area of resistance, I think, is going to be right around 17. That was the high in October, got close in November, false breakout in December. Now we're testing the rising 20-day. So I like it, but it already has bounced the last 2 days off of that 20-day. 20-day would be great entry.
Okay, excellent. Let's look at steel, Nucor Corp, NUE.
All right, NUE, bouncing off support, nice reversing candle, but the overall downtrend is in play. So if I was trading it, I had to trade it. I would probably do it from the long side just because we did reverse off of a downtrend. So I'm thinking in the short term, I'd be looking for maybe a 20-day test, and that would be up at 58.40 right there. And to the downside, you've got support. I mean, I could probably draw that other support at the open that we just saw right there, but that's definitely key support. So I'm closer, much closer to support than I am the resistance. So that's why, from a short-term perspective, I would be long if I did anything. But the overall trend here is down, so I'm not really excited. I don't want to come across as being overly bullish. I just think short-term we might see a bounce from support.
All righty, let's see next one up. This is an interesting ProShares short financials ETF, SEF.
All right, well, financials had been going straight down. Obviously, this is going straight up. So, this was at 22.50, 10% lower just 2.5 weeks ago. So I'm not going to buy something after it's already made a huge move. I mean, financials are due for a bounce. If we hold support where we are on the S&P, which, maybe we do, maybe we don't. We'll be looking at that just a second. But if we were to hold and have a nice reversal today, I think financials, because they've been such a laggard, could get a bounce. And so I don't want to be chasing after a huge move up in something like this. I would be instead looking for a pullback in the two key areas, looking at this. Now, I don't know what index this ETF tracks, but I think right now, actually, I don't even need to put that line in. I would be looking at the price support that I just showed here, along with the rising 20-day moving average, which is down below 24. I'd at least like to see the market bounce a little, have this pullback, and then I think your reward to risk could set up. So I'd have patience here. I don't like what's going on with the financial, so I think this is certainly an area of the market that you could concentrate on from a short perspective, but I don't want to do it after it's been, this inverse ETF has been up 10 straight days or 9 of the last 10 days, whatever.
Right. All right. Our only technology sector request, a Lattice Semiconductor, LSCC.
All right. I would short it. I mean, if I was right at gap resistance, I mean, this is a key area. I mean, this stock gapped down on 4.5 million shares from $7.05, $7.10. And here are your tails above that level. It's failing so far. The good news, I guess, from a bullish perspective is that we tested the 20-day and we held. So I think we're in this range between about 645 and 705. If it were to break out, close above, say, 710, or intraday move up above this low from Friday, which looks like maybe around 720, then I would change my tune in the short term. But I think a lot of times this is what you see right before a big reversal back to the downside. So I'm not a fan here. I would be on the short side, if anything.
All right. Well, that does complete the 10 and 10. And here are the symbols that Tom just annotated for you. And they will be up in the Market Watchers Live recap blog. All you have to do is go to the go to the blogs tab, and then go to the Market Watchers Live blog, and you'll see the link for the chart list at the top, as well as all the recaps that I write at the end of the day. All right. It is time for our final market update. What is going on? It doesn't look good, Tom. That's what I can say.
Yeah, it's definitely iffy.
Yeah. All right, here we go. All right, well, as you can see, we tried to make that rebound back to positive territory on the Dow and S&P, as well as the NASDAQ. NASDAQ and mid-caps did manage to get a little bit into positive territory, as well as the Russell 2000, but everybody has turned back down, and we're now challenging intraday lows. The S&P is currently at 2573.72. See, Canadian markets are following suit, only they have now made a new intraday low. Treasury yields sitting near the intraday low as well, currently at 2.864%. The VIX is rising there, Tom. We're at 23.44 for the VIX. UUP, the dollar did gap down on the open, and it looked like we were going to just consolidate sideways, but now the dollar is starting to break down again. Gold, interest in gold is clearly going up. We actually have a parabolic going on right now, I would say. intraday for GLD. Currently, it's up 82 cents to 117.88. USO is down 1.4%. Currently, USO is reading $10.67. And finally, TLT, not surprising to see bonds doing fairly well today. The TLT is still reading $118.99, almost $119 right now. And that's all I have for my share of the market update. What do you got for us, Tom?
All right. Yeah, I would just agree that, things are not looking good right now. Of course, when you get a volatile index like this, or when the volatility index is up in the 20s, the way it is right now, I mean, literally from morning to afternoon, sometimes even from hour to hour or 15 minutes to 15 minutes, things can change. Earlier today, I was really liking the reversal, moving below price support, then turning back up. But at this point, it's looking like nothing more than a gap fill and a move lower. This is a 60-minute chart. So this is a 1-hour chart of the S&P 500 over the last month. And we did not even get to that 20-hour EMA before printing a pretty bearish looking candle here and moving back to lows. Now, maybe we just sideways consolidate. I think the end of the day action is going to be really important today. If we get impulsive selling to the downside and there's a washout, I think the market's in big trouble. Now maybe not, it could still be higher a month or two from now, but I believe if we set new lows, that we have reversed the course of higher highs and higher lows in a bull market to one of lower highs and lower lows in a bear market. And so rallies, then the difference for me is that in a correction, I want to be buying into those rallies. In a bear market, I want to be selling into those rallies. That's the difference between the two. So I don't know. We'll see how we finish today, but I agree with you. I'm not really liking the action right now, but give me another 20 minutes.
Okay. I will give you 20 minutes because we can talk after the program. Everybody else may not give you that time. All right, it's time for the final segment. I'm going to be doing the decision point sentiment update and show you what is going on right now as far as sentiment is concerned. And I think the charts are really interesting right now, and I can't wait to show you the RIDEX ratio. So let's go ahead and get started. I'm going to be going over as far as sentiment. And remember, sentiment is contrarian. So the more bearish people are, the more bullish it is for the market. So we're going to look at the put-call ratio, American Association of Individual Investors, NAME, National Association of Active Investment Managers. We're going to look and see what they're doing as far as exposure to the market, the RIDEX ratio, which I teased you with just earlier. And we'll look at the Wall Street Sentiment Survey to see what market timers were thinking this week was going to turn out to be on Friday. And then I'm going to show you the VIX. And finally, I'll finish off with some gold sentiment. So let's go ahead and dig in. All right, so this is the Wall Street Sentiment Survey. Everybody can take the poll. We'll probably look at that before we leave the program, but we have to take a poll that's basically the same one as you. It says, how will the S&P close by the end of next week? Will it be up, down, or mostly unchanged? And right now, I think it's pretty obvious. Most of our market timers are feeling quite bearish. Not as bearish as we have seen as far as readings go. The ratio, however, is the lowest we've seen in quite some time. So we have certainly way more bulls than way more bears than bulls, but we're not getting excessive readings on the bearish side. So while I do look at this, these are contrarian typically. I would start looking for a bit of a rise here, but you can see we've had these same setups, and we even had more bearish readings than before, and then they had started down. So I think the fact we don't have these really high bearish readings on this low ratio, I think that does tell me that I think we have something good here as far as looking for a rise, like we had back here maybe in March after we went through that correction. It's time to make that dead cat bounce, I think they call it. All right, next up, the put-call ratios for CBOE, equity, and OEX. And what I look for, of course, are peaks and valleys, tops and bottoms. And right now we're looking at the tops because we just did top. Typically when you get tops on the put-call ratios for the CBOE and equity, When you see those top at about the same time and start lower, that suggests you're going to be in a downtrend until you get you start to see it decelerate or turn back up. And right now we have topped both of these. You can look in the thumbnail, headed straight down. I don't see any deceleration. If anything, like you can see on the equity put call ratio, I'd say that there's an acceleration going on here. So at this point, I believe that we're going to still see these put call ratios fall further, and that would mean that we should look for some more decline in the intermediate term, is how I would look at this one. All right, this is the American Association of Individual Investors right there. And this is the poll. You can go to aaii.org and find their sentiment poll. This is for anybody who's there, wants to give their opinion. Right now, so this is, to me, this is your cats and dogs. It's everybody. So it's how everybody's feeling about the market right now. And I think it's pretty clear everybody is very bearish. And what I do want to point out here are, the last time we had these type of bearish readings close to 50 or lower, we had it back here at the third quarter of 2017, and we failed, which tells you the market was very weak there. We had high readings back here. The first one, we got a little bit of a move off of. And the second one, we got a little bit of a move that actually continued on the rally side. Back here, similar, got the rally off of these very bearish readings. So I think it is positive and actually bullish in the intermediate to short term here for sentiment, as far as sentiment is concerned. This is not a primary indicator. I don't use this as my primary to tell me where the market's going. This I use as confirmation, or just to get a feel for where everybody's head's at. But you can look at the VIX and find out all these kinds of things. But I don't use that as my primary indicator. So I just wanted to lay that out there for everybody. All right, next one, NAME, National Association of Active Investment Managers. These are the big guys that manage lots of money, and they report how exposed they are to the market. So when they have very low exposure, that means they're quite bearish, and that is bullish for the market. And you can see where we've had similar situations like that. We don't have these deep exposure readings down to the levels that I'd want to see before a nice rally to the upside, or to end the correction. I don't see low enough exposure readings here that I'm getting that kind of information. You can see right here I've gone ahead and drawn a horizontal across today's reading, or this week's reading, and you can see it's pretty much middle of the road. I mean, we're not seeing much on the top half or the lower half. There's just a mixture of both. So I really look at this one in the neutral position, because we do, while lower exposure than we have seen in 2018, typically, this is among some of the lowest readings we saw in 2018. But I don't look at this as a low reading. I think this is middle of the road with all things considered. So long story short, on the NAME chart, it's neutral. Okay, RIDEX ratio. This is the one I've been excited to show you. I went ahead and I pulled this chart out to 2 years because I couldn't see. It's just like with price. If I don't see that price support on my daily chart for the year, I'm going to pull it out because I want to see. I need to see what the indicators or the price is doing, where the support levels are, etc. So I wanted to pull out this chart because I had these very low readings. Well, it's an inverted scale, so these are very oversold readings, and we haven't seen oversold readings to this degree on the RIDEX ratio since way back here in 2017, where we got these very low bearish readings here on the RIDEX ratio. So we have definitely a switch in gears here as to where we're going. And look at it. I mean, we are now, I put it at that level that we're at right now, and you draw it across. We haven't gotten much above that as far as get people getting interested in the bear funds. It comes out right about the time we were in the midst of this correction. the last time we saw a reading in this area for the bear funds. And so I'm seeing this increase in the bear funds. Look at what happened with money markets. Now, if you recall, when I gave the sentiment report last week, it was kind of a strange thing because we had a rise in the bear funds, but we weren't seeing it in the money market funds. So people were not necessarily moving to cash. They were just, throwing the baby out with the bathwater, I guess they say. Just everybody was going into those bear funds. Now we're still seeing an increase in those bear funds right here, but we got a real big spike as far as the money markets are concerned. And you can see we haven't seen that level just like back here since 2017. And now look, what happened to the RIDEX bull and sector funds? We lost quite a bit in the way of assets to the point where we can go back and not see assets totaling this in the bull sector since before 2017. So I'm seeing very, very bearish activity going on with money flow, highly bearish. And honestly, that is bullish for the markets. You know, that tells me if people are with their money are being that bearish, that we should start looking for at least a short-term rally to the upside. So I don't know, though. You look at this, you can see that important support level here on price having been broken just when you use that solid line. Next one, let's look at the VIX. All right. And what sorry guys, it's a little bit sensitive today. What I look at for the VIX, I look at it in the very, very, very short term. So when I see highly bearish readings that just spike up there, I would expect the next day to start seeing, you know, some upside. It doesn't mean we're going to get it to be up for, you know, days on end, month on end. It just means that we've gotten this spike in fear, and it's just you have to pull back from something like that. It gets so extreme. And when you get those very extreme sentiment type readings, when the VIX, in my opinion, when you're using it in the short term, is a sentiment meter. I mean, we still use it as a sentiment meter even in the longer term. But in the very short term, I like to reverse the VIX, because to me, the very high readings, those spikes, those climactic readings on the VIX generally spell good things if the VIX goes very high, and not so good things if people get way too comfortable. You know, we had a highly volatile time here at the end of October. The volatility is starting to, at least the Bollinger Bands are starting to shrink a little bit, and I think that's at least a good thing. But there's shortening up here on the high side, which we don't really want to see overall. But we're getting this puncture of the bottom Bollinger Band right now, and that tells me to look for some upside. But notice in the thumbnail, we haven't actually punctured it. We still could go lower. We could still see the VIX rise a bit more before we start looking for that, what I call them a rally pop, the next day or two. You usually will get that rally pop. It might not even last the whole day, but you'll get the pop, and then it'll come back down. And that's usually just based on the fact that we have such bearish short-term sentiment when the VIX raises to those kinds of levels. All right, final one we're going to look at is gold sentiment. We track gold sentiment by tracking the premium and discount for the Sprott Physical Gold Trust. If you want to read more about how that's calculated, it's certainly in the chart school area. But just in a basic way for sentiment, when we see lots of discounts and we see them very high, like you have over here, that tells you that sentiment is very bearish on gold, because you're getting a discount rate here to get people are you know, they're just not as interested. And so you have those high discounts. Right now, you can see we pulled way, way back on those rates. However, when I drew a horizontal at those readings, it's still pretty high until we got into that mid-July area where we saw that spike on the bearish activity for gold, that those discounts really rise. This was the high side. for over a year. This was the high side as far as the bearishness. So I would still think that this is bullish for gold. And then you look at this and you can add in this move to the upside on the PMO. It had turned down. Now it's immediately turning back up. You can see with GLD right here today, we got move back up above that area of support at like 117. It looks like, yeah, 117 area. So I like that. I think gold's looking pretty good. And, as Tom was saying, I feel like the dollar is looking pretty soft right now. I think it's still in a rising trend, but it's in that part of the trend that, you're going to see a little bit of backing off. So let's go ahead. I'm going to go through our summary and then we'll look at the poll. All right, so the 10-day movement, the put call ratio, it's topped and it is declining, and that's actually bearish for the market because typically when we start seeing that decline on that inverted put call ratio, that tells us that that people are starting to you're starting to see that bullishness, but you get that top in overbought territory and it starts to move down. Like with any indicator, if it's moving down, that means that it's still bearish for the market, because that's how I read that ratio, by inverting it. AAII, highly bearish sentiment. Remember, very bearish sentiment. That is bullish for the market. Name the exposure. We have pretty much neutral readings. We had a slight pullback. We increased it just a little bit. I would say it's still pretty neutral for the market. The sentiment survey, I think, is highly bearish. Everybody came in very bearish. That ratio as well was very bearish, and that is bullish in the short term for the market. And then if you go and take a peek at that RIDEX ratio, we have major increases in bear and money market funds, and that's very bullish for the market. You had that large decrease in the bull funds, very bullish for the market. The lowest RIDEX ratio reading since 2017, also very bullish for the market. So as far as the money flow goes, it's kind of leaning toward the side of a rally right now. And breadth and VIX, I think, is also near term. We're getting ready to penetrate the lower Bollinger Band on my inverted VIX scale, and that is bullish in the near term for the market. And finally, gold sentiment. We've seen discounts falling, and it's still bullish for gold, I would say, because we're still at the top of what we saw in prior years, and the PMO is rising now on a buy signal, so I like it. That's all I have for our sentiment update. Let's go ahead and bring up the poll. And I know what your answer is going to be, Tom. Well, I have to wait till the market closes.
Yeah, that would be a big one.
Yes. Well, normally what they do, and it's always been a little bit tricky here with the Market Watchers live poll, is that they tell us that after the market close on Friday, that's when we give our opinion. Well, of course, the poll that we do for Market Watchers viewers, we're in the midst of the end of the week, and right now we're at the beginning, so we've actually gotten a little hints as to what might be happening. I actually went in mostly unchanged.
You went unchanged.
Yeah.
I don't think it's going to be unchanged. I think it's going big one way or the other.
Yeah. Well, I feel like it's, going to balance out ultimately. I think it's going to be volatile.
Yeah, I think that it could be something like we saw back in October, back in February. If we lose support, it holds into the I think there could be a lot of selling going on at the close and big gap downs. Right now we're below. I'm going to assume that's where we close. I mean, you can see how fast. I mean, the market's just kind of going back and forth trying to figure out what it's doing. But I'm going to make the assumption that we break down today. So I'm going to say we go lower this week. All
right. Yep. I think actually I will admit. No, Friday I did turn in a bearish reading. So I guess I have to go with that. But I was, like I said, we get to cheat a little bit just seeing what's going on with the market action today.
All right. Well, we will soon find out. I want to thank everybody for being with us today. Please remember to complete the survey as you exit. We do like to hear what you think of Market Watchers Live. That survey is located below your video player. Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great afternoon, everybody. Check out that close today, and we'll see you tomorrow. Happy trading.